All right, guys, welcome back. So, as requested, I'm going to show you guys a quantitative trading strategy that I actually think is very interesting. Now, I want to explain something really quickly. As algo traders, we are the in between traditional day traders, meaning support and resistance traders, price action traders, and quantitative analysis, or quant traders, which essentially do what I'm about to show you right now, which use heavy statistics to determine relationships between multiple equities in order to profit off of the movement based on that relationship. That's very key. So let's think about it this way. So essentially, day traders will trade one or multiple stocks in one day. Quant traders will find thousands of stocks that have a very similar relationships and trade them in the direction of that relationship. So who do you think makes more money based on that? Thousands versus like probably 10. Now, I'm not saying that quant trading is better, but I'm just saying it's just something also to have in your tool belt as an algo trader. All right. So what I'm going to do right now is, as the name states right here, you've probably seen it. It's a statistical arbitrage trading strategy. Um, First, before I get into building the full thing, I need to kind of build you guys up on the foundations of some of the things you're going to need to know in order to build this. Just like I had to learn these things to build this as well. So this first video is going to be focusing on one topic within this, which is called the Z-score. The other two videos are going to build upon that and then finally get into the actual strategy build. Unfortunately, those other videos are going to only be in Algo World. So if you want to sign up for Algo World, I highly suggest you do today, since today is the last day of the Juneteenth sale. So you get 1 month half off. So definitely go sign up for that if you want to see the continuation of this project after this. But I decided to drop this first video on YouTube because it actually does two things. One, it's going to show you the topic of Z scores, but then also show you in a way that you can apply to your day trading now, essentially going in the following week. So it does two things at one time, which makes it a great first video and also a great video for my YouTube community. But for everybody else who wants to see the full strategy, see the full learnings that you're going to need, sign up for Algo World ASAP. All right. So first, let me define certain terms. All right. First, what is arbitrage? Arbitrage is a simultaneous purchase and sale of same or similar assets in different markets in order to profit from tiny differences in the asset's listed price. Um, so it exploits short-lived variations in the price of identical or similar financial instruments in different markets or in different forms. Don't worry, I'm going to show you. I have a visual right here, but first I want to get through these definitions before we get there. All right. Next, what is statistical arbitrage? In the world of finance, statistical arbitrage, or stat arb, refers to a group of strategies that utilize mean reversion analysts to invest in diverse portfolios of up to thousands of securities in a very short period of time, often only a few seconds, but up to multiple days. Exactly what I explained before. Now let's get into the next one, Z-score, which we're going to do now. A numerical measurement that describes a value's relationship to the mean of a group of values and is measured in terms of standard deviations from the mean. And what is a standard deviation? Lastly, standard deviation is a measure of how spread out numbers are. Now, if you didn't get those last two, don't worry. I got a diagram. I just wanted to kind of get through that because it's needed before we kind of get into the build. All right, look at my diagram. Boom. So this black line here, again, is going to be the mean or the average of these values. So we're going to say that these four lines are four different stocks, right? And the black line is the average. So we figured out that these four stocks have the same average or the same mean. Now we're going to trade all four stocks in relationship to this mean. Now, please note, do not go in my comments saying, but the mean is not going to be horizontal. I know the mean is always changing with the values of the stocks or whatever it may be that it's averaging out. So it's not going to be a horizontal line. It may be more like a vertical line, but I just for demonstration purposes have it as a horizontal line. So get off my back. All right. So these two stocks that are up above the mean, we're going to trade them in the direction of the mean, meaning that we're going to sell these short because they're going to revert back to the mean. All right. And these two stocks that are below the mean, we know they're going to always go back to the mean. So we will actually buy into them as they go back to the mean. That essentially is what statistical arbitrage is doing. that is how you trade within mean reversion. You figure out where the mean is, and then you basically buy or sell based on how far away above or below the actual equity is from the mean, and then you trade in the direction of the mean. That's basically it. So that explained literally all of this with just a diagram. I love pictures. Hope you love pictures too. All right. All right. Now let's get into the code. So we're gonna focus on z-scores. So a z-score is, as we said here, it states the relationship from the mean for a group of values in terms of standard deviations. So for most people, most quants, they give it about 2.5 standard deviations. So if equity goes away 2.5 standard deviations away from the mean, most quants look into trading it in the direction of the mean. They think that's like a red an alert to trade within the direction. So let's go back to the image here. Let's say this one has now hit 2.5 standard deviations. This is where a quant is like, okay, let's now sell it short so it goes towards the mean, because we believe it's gonna go there. So same thing with if this one was below the mean and it's now a negative 2.5 standard deviations away from the mean. We would buy into it at that point, hoping that it goes towards the mean same way. So that's how you trade it both in both directions. So you look for a z-score of around 2.5 as an alert to either buy or sell depending on which direction of the mean the actual equity is. All right. So that's what we're going to do now. We're going to define the z-score and see if we can find any stocks that are 2.5 standard deviations away from its mean. We're first going to find the mean, then we're going to see if we can find any stocks that are close to 2.5 standard deviations away from the mean. I pretty much already know one stock, so I'm probably going to start with that. But there's some other ones that I'm going to probably show as well too. All right. So let's start with the imports. So let's import numpy as np. My computer is actually very hot, so I'm actually going to see me moving this thing around if you're looking at my screen right now, because I got to actually make sure it doesn't overheat. Otherwise, I'm in a crap ton of trouble. Let's import y finance as yf. Okay, now I'm going to pull this up again. And now we're going to create an object to actually calculate the standard. So to actually calculate the z-score. And to create an object is where you basically go utilize the class. And that allows you to build your own objects. So actually let's call it stat arb. And the first function in your class object should always be the initializer function. So init. And all functions within a class always take the first parameter of self. So that's going to be the first one that you're going to use. All right, now let's get into it. All right. First thing we need to do is we need to define the ticker, which is going to be yf.ticker tickers. And let's do Apple. Again, I already did this already, so I already know Apple is like the perfect starting point. Yeah. Next one, we need to do self.data because we're going to now get data on Apple stock. So yf.download tickers equals put this in brackets. And for this, we gotta set the period to be 1 year because we need 1 year worth of the averages. Well, to figure out the average, we need to actually get it for a year. Intervals, we're just gonna focus on days, on day data. a data. All right. And we're going to group by ticker. And pre-post. Okay, we should be all set from there. Psych. No, we're not. We also got to define the data frame. So self.df, and that's going to be good old pandas. So pd dot data frame. And that's going to take in the data that we actually created here. So we can create that there. So now we're going to be building the data frame from that. And lastly, we can now print, we need to print the current value within the data frame. So if you understand Python, you know that that's going to be the tail value, and that's going to be the first of the tail value. Right? All right. Now let me run this before I continue. What's wrong here? I forgot the space. Don't get mad at me. I forgot the freaking space. I'm sitting here like, what the hell is this? All right, now we need to define the Z score. And remember, I found this on the web. Thank you. I pressed the button by accident. I apologize. Remember, all functions within a class object always take self as a first parameter. There's nothing we can do about it. We just gotta suck it up and just allow it to be, allow it, fam. And this is where we're going to define the mean or the average. So it's gonna be self dot data frame. So we gotta pull up the data frame, and we're gonna do the average of the closed values. We always use closed values in any trading script. I don't know. And if you remember pandas, well, if you are in algo world, you know that pandas has NumPy already built in. So it has some numerical Python based functions such as the dot mean, which comes from NumPy. All right. And now we're going to do Z mean, which is we're going to now define what the Z score is from the average, which we defined above. So this we do self dot df close. And we need the tail object 1. And now we need to subtract the average. And guess what? We need to now divide it by standard deviation of the close. So dot df. Okay. And that is how you get the Z score. And lastly, we just want to print the values. So APL self df close. What I like to throw in there is the mean as well, and then the. All right, let's run this. All right, no issue. So we can do S equals, or let's do Z equals stat. And I'm just basically substituting, basically putting this into a variable that holds the actual class object. Let's run that. And download got an unexpected interval. Oh shit, it's interval. My bad. interval. I actually spelled the whole thing interval. Spelled that whole thing wrong. There we go. Spelled that whole thing wrong. That is crazy. V underscore score. All right, cool. Spelled that whole thing wrong. That's crazy. All right, so the current value, this is the current value of Apple towards the close, which we can look at now. 186, cool. Yep. The mean is supposed to be 153. So it's currently above the mean by 2.3 standard deviation. So you remember we said 2.5 is probably the highest. So that means that Apple will essentially probably fall within the next coming weeks towards that standard deviation. I'm sorry, towards that mean of 153. So this will be a great selling opportunity once it gets a little bit closer to 2.5. So that's one way to look at it. And yeah, so that would be a great way to kind of look at it. So that means Apple's a little bit high. As you can see, it actually did go up a lot. So let's look at 1 year. Yeah, you see it's actually been shooting up a lot. So it was around the average, what was that? Around March is when it was around the average. So that means that definitely look for Apple possibly falling within the next couple of weeks. All right. Anyway, if you guys want to see the full buildup of this, first of all, play around with this. If you don't want to hard code the tickers, you could actually put the tickers outside of this function. It's up to you. But yeah, definitely play around with this, see what else you can find, and also kind of like look at the movements while you're watching the stocks play out throughout the weeks. All right. But if you want to see the full build out of these strategies, of the strategy itself, you want to see me use multiple different stocks and define this for it, and then define the buy and sells for it, utilizing some of our popular brokers like Interactive Brokers and Alpaca. Then definitely sign up for Algo World. Again, this is the last day for the Juneteenth discount, so sign up if you want to learn more. Otherwise, good luck building on this on your own. I'm probably try to see if you have any questions, DM me on Instagram. I'll see if I can send you any resources. But yeah, if you want to actually see how this is built out, sign up for Algo. All right, so see you guys in the next video. Peace and enjoy your Sunday. Happy Sunday. All right, bye.